Anyone else hear me?
Hi, it's Mindy. I can hear you, Tracy.
Hey, hi Mindy, it's Tracy. How you doing?
Good. How are you?
Good, I'm good.
Good. Who's writing to me as Bob? Is that Rebecca?
Yes.
Or is it Bob? I didn't think it was Bob.
Rebecca's running the call. I'm going to do a
Great.
short intro just to get DJ on, and then Rebecca's going to give him control of the call.
Awesome. And then I'm trying to see if there's a place. I don't think that I get to see participants.
Okay. Well, I can certainly get that then after the.
Yeah, just so I can follow up with them and see if anyone has any questions, and also just kind of log that in our notes that whoever attended.
Yep, that works.
Would be awesome. How was your Thanksgiving?
Good, good. How about yours?
It was good. It was quiet. Just my foursome plus 2 friends, so it was good.
Oh yeah, we had a small.
How about you?
Yeah.
You had a small one too?
Yeah, when it's small, it's nice.
We had I'm not gonna lie, I've been eating Thanksgiving meal for days.
Oh, yeah. Well, that was the nice thing. We went out, so I didn't have that, which is good.
Oh, good.
I don't.
Yeah. All the leftovers, man. My husband there were 6 of us, and he got a 23-pound turkey. I think he was hoping a couple more people were going to join us.
Oh,
I'm like,
yeah,
that's so much turkey. Like, we're going to have to start giving that to the dogs.
Yeah, there you go.
So, well, good. I'm glad it was good. I don't know. Yeah, I don't know what you see on your end. I can't see. DJ, are you on yet?
Just got in. Hi, Mindy.
There he is. Hi, DJ. Tracy, I'm going to botch it. Sugart, right? Sugart. You said it's like yogurt, but sugar.
Yeah.
Tell me.
Sugar and yogurt. Sugart.
Sugart. I knew I was going to botch that. Anyway, Tracy Sugart is our host today. So, DJ, yeah, I'm sorry, Tracy. Elliott he's actually doing a whole lot of construction on his house, and he had an emergency with that project. So
that's no problem at all.
DJ is fabulous. He's out of San Francisco, and I just sent you his bio. You got that, right?
Yes, I have it. Yep.
Yeah. So thank you, DJ. Appreciate it.
Yeah, my pleasure. Happy to help. Hi, Tracy.
Hi, how you doing? I'm
great.
I'm going to give you a short intro and then let you take it away. And
Okay.
Rebecca here in our office will give you control of the call so that you can run your slides.
Yeah, it says I've been made the presenter. It's asking when ready to show my screen. So
go ahead and do that.
Yeah.
I'll just give an intro whenever it's when it hits 1 o'clock, we'll get kicked off.
Sounds good. I'm just closing a few apps so you guys don't see all my crazy personal pictures on my computer here. I'm closing Bloomberg because it has a lot of pop-ups, and I'll be ready in a sec. Let's see. And were we planning on this being about an hour or less? Is there a time frame that fits your team better, Tracy?
Yeah, we have allotted about an hour, but obviously if you finish sooner, that's fine. I don't know if anyone will have any questions. Some days we get lots of questions, other days everybody's quiet. So
we know how that goes. We know how that goes.
So whatever time you need is fine.
Yeah, I'll endeavor to wrap up the presentation in 45:50 to allow for some Q&A, and then I do have another engagement at the top of the hour. So if we wrapped up and I jumped off a couple minutes before, that would be great.
Yep, no problem at all.
Okay.
And so everybody else joining the call is in. They're muted. Is that what's going on?
That was what I thought, but I'm not sure because we're all talking.
Yeah, and I don't know. Is anyone else out there joining us?
Mark's here.
Hi, Mark.
Hi, Mark.
Hello.
How are you?
I'm doing great, thank you. And
you?
Good.
Thanks. I'm good, thanks. Good Thanksgiving?
Oh, it was great. The turkey was really good. It was nice and moist, and yeah.
Awesome.
Can I ask
Thanks
you all
for joining
if you
us
see
today.
a screen at this point?
I do.
I do, DJ. Yes, thank you.
And do you see just a clean, or does it appear to have two screens in one?
It has the two screens. So we see the headline page, and then there's on the side it says next slide.
Yeah, let me see if I can switch this then.
And Tracy, are you able to see if everyone you thought were joining us did join us?
I am not, but
So Rebecca probably has that.
Rebecca is the one that can see that.
Hey,
Rebecca,
can you hear me?
there you are. Hi.
I've had myself on mute. It looks like we're still waiting on maybe one person.
Okay.
So you could probably go ahead and get started in the next minute or so.
All right, great. Thanks, Rebecca.
Sure.
Yeah, and if one of you would shoot me a quick email as to who has joined us, that would be great.
Okay, yeah, I'll do that for you.
Awesome, thank you.
And did the screen view change at all there?
Yes, it looks good. Yep.
Now it's clean?
Okay.
With just one screen?
Yep.
Okay.
Okay, I'm gonna get things rolling here because it's 1:01. So, so thank you to those of us, for those of you who have joined us. Schwab came out and did a really great presentation for us at the meeting in October. It was on Friday morning, and it was 2 meetings at one time, so some of you didn't get to participate in the ETF portion, and I had a couple of people request that we do it for everybody, so this is what we're doing, and I want to thank Mindy for helping me get this set up. DJ Tierney is going to be presenting this morning. He's a senior client portfolio strategist at Charles Schwab. In his role, he represents the Schwab ETFs to sales channel clients and media. He also works with Charles Schwab's product management and marketing teams to produce educational and market strategy content for index products and ETFs. Prior to joining Schwab in December 2016, Mr. Tierney spent 16 years with Morgan Stanley as a senior institutional sales, trading, and relationship management professional, where he worked with asset managers in the rollout and trading of ETFs. Mr. Tierney earned a Bachelor's of Arts in Economics from the University of California, Los Angeles, and a Master of Business Administration from the University of California, Berkeley's Haas School of Business. He holds his Series 7, 9, 10, and 66. And thank you, DJ, for doing this for us. You can take it away.
Well, thank you very much, Tracy. Pleasure to be here with all of you. So in my background, when I was at Morgan Stanley, I was introduced to ETFs back in 2002. One of my clients brought the very first bond ETF to market. And so my team worked closely with them in seeding it, bringing it to market. And then eventually, as it hit scale and became a multi-billion-dollar ETF, we created an arbitrage trading book to face it, to help with all of its creations and redemptions. And I ran that trading effort for 7 years. As the bond ETF environment grew, we became one of the top authorized participants for bond ETFs. So that was kind of my intro to ETFs. And I've been in this role at Schwab for 3 years. My team created this deck. This is an example of the kind of thing we do. We're really, we exist to help advisors understand and embrace ETFs and put them to use in their portfolio. So the goal here this morning is to walk through the ETF landscape, to show you all kind of how the environment continues to mature and develop. We will cover, of course, all the key features of what defines an ETF. We'll go into what we think is important when choosing ETFs among all the 2,000 choices you have out there. And then we close with some facts and myths. And it's not clear to me how, if you guys are all muted or not muted, but I would encourage questions throughout. And then the design is for me to wrap this up and leave time for questions at the end too. So if you're muted, maybe email them in. And if you're not muted and I say something that doesn't make sense, feel free to ask questions throughout. So first, why are we even here? Well, ETFs are garnering a larger and larger share of fund flows. We think a lot of that is justified based on what they deliver in terms of cost and tax efficiency. But one of the points we like to make on this slide is that on the left, you see the growth inflows into index mutual funds and indexed ETFs. And this is a story we like to emphasize. Index mutual funds themselves are not going away. And in fact, it's the index part of ETFs that's contributed to a lot of this growth. And if you look at index mutual fund flows alongside, you see ETFs are growing faster, garnering more assets, but index mutual funds are doing quite well as well. And then if you look on the right side, the portion of the asset management industry that is indexed versus active continues to tip the scale towards index's way. By our count, and this is ICI data as of the end of 2018, we think around a third of the asset management is indexed and 2/3 active. There's been some popular press this year that say by some measures it's closer to 50-50 now, but it really depends on whether you're including pension assets and others. And by in a total view, we think this is closer to reality right now, about 1/3 and 2/3. But beyond just the indexation that's going on in the markets and the move towards passive, ETFs, are growing faster. So take a look at this. This is the last 18 years. You can see from, back there in 2002 when I started trading bond ETFs, as they entered the business, assets were in the few hundreds of billions. And now, as of today, we're over 4 trillion. So this is growth, both inflows and asset growth. So market appreciation has certainly helped over the last decade. And by the way, the market performance is why you see this big flat line at the top of the blue shading from 2017 to 2018. In 2018, we did have $350 billion come into ETFs, and almost the exact same number of assets were lost in a down market in 2018. So that's why you see a flat line. Inflows were offset by a down market for risk assets. Of course, this year, both are in the same direction. Risk assets are up dramatically, and inflows continue to go up, approaching 300 billion year to date. So thus, we're well over 4 trillion. The line here, the number of ETFs offered, is an important part of the narrative. You look back at 2000, there were a sum total of 80 ETFs. There was a point in time when I knew every ETF that was on the market. I could give you the ticker and the strategy. That is no longer the case with over 2,100 now. I can't keep track of all these new ones that come out. So what that means, though, is the choices that are available to you as an advisor. There isn't really an asset class or a strategy that hasn't been offered now in an ETF. So it really gives you the ability to assemble a very diversified portfolio across risk assets and asset classes. And it's almost like the number of choices are part of the growth story now, particularly in fixed income, where 10 years ago you had a handful of choices: corporate bonds, treasuries. Now, you can buy a corporate bond ETF with a specific maturity band. You can buy it by ratings. You can buy it by sector, and the same thing in treasuries across the treasury maturity spectrum, treasury inflation protected securities. There isn't a direction that you can't go with ETFs. And we'll talk about what the features that are in common across all those asset classes. So, and it's not just the asset growth and the number of ETFs, it's also the number of offers. And yes, and I do like to point this out. ETFs now make up a little over 16% of the fund asset management industry. So while this growth is really impressive, 4 trillion on a base of an asset management business that is in excess of 20 trillion, we have an ETF for the whole world. And I don't think that ETFs are playing too big a role in broad markets in terms of price impact. They're still relatively small, and they're still dwarfed by actively managed mutual funds. The growth is expected to continue. There were a couple years ago, back in 2016, when we'd say that ETFs are going to be north of 6 trillion, everyone's jaws would drop. But now that we're north of 4, it actually doesn't seem like that much growth built in. But there is, the flows are steady. The choices that you have among price points and asset classes, the demographics of baby boomers entering their retirement years and their need for making asset allocation moves will probably all lead, and we're seeing that's part of the story of fixed income ETFs growth in 2019. We have pretty strong reasons to believe that you're going to continue to see growth north of 6 trillion. I mean, there are industry forecasts out there north of 10 trillion in the next decade for ETFs. So it makes a good case for anyone in the business, any professional, to understand the vehicle since it's occupying a larger and larger part of the footprint. So the number of ETF providers has jumped, even more dramatically, really, over the last decade. It's crazy. Back in 2005, there were a total of 7 firms that were offering ETFs. Now we're over 100. And what I think is really compelling is just that the types of names that have joined the business in the last few years, right? Prudential, right? That's an insurance company with a 100-year heritage. Franklin Templeton, right? The definition of international active management is now in passive indexed ETFs. Goldman Sachs, JP Morgan, Wells Fargo have all joined the ETF industry, both their first ETF offerings in the last 5 years. So, it started out as a kind of a specialty business. Then, hey, look, we got in 2009, and now, there really aren't the number of asset management providers that are not in ETFs is becoming the more noteworthy number. And even then, with the advent of these new active strategies, we would expect, if you've got a structure that can accommodate a cloaked active strategy, we think that'll probably bring everybody else in that's not in. So would lead you to believe that ETFs are here to stay. So summary, over 2,000 ETFs now, over 16% of the asset management industry is in ETFs. 78% of the assets are in equities right now. Again, equity ETFs came out in 1992, so they have a full decade jump on fixed income. Not to mention that fixed income in the last decade, we went through the zero interest rate environment, so it wasn't all that compelling to jump in. As we've gotten a little bit of yield back in the yield curve, you've seen money come in. The demographic shift would suggest that maybe the next trillion or 2 trillion that comes into ETFs may be led by fixed income over equity. But as of right now, it is a majority of assets are in equities. There is a concentration of providers at the top. That 90% of ETF assets are held by the top 5 issuers, of which Charles Schwab is one. Granted, we're number 5, but we're in the top 5. There's a real concentration among Vanguard, BlackRock, iShares at the top. And then once you get beyond the first 2, it gets a little bit more diversified. And there are a lot of providers that are kind of entering the 50 to 75 billion in assets at Schwab, and I'll try to avoid plugging us too much, but we're at 160 billion at the number 5 spot in ETFs. AUM as of end of last year, it was 3.4 trillion. As of today, we're well over 4 trillion. And again, 87%, a vast majority of ETFs are in index strategies. So in other words, 13% are in active strategies. And we would expect that number to grow, but not too quickly, just because a lot of the advantages that are inherent in ETFs are accentuated in the index strategy in terms of tax efficiency and low cost. When you go to active, it does water down some of the key features and benefits of an ETF. So we expect that active ETFs will continue to grow, but maybe I don't know that the percentages are going to expect it to change dramatically in the coming years. So that's a good segue to this, which is you can buy ETFs across the whole spectrum. In the beginning, it was traditional indexing, right? 1992, SPY was the first ETF. SPY replicates the S&P 500. So when you buy SPY, what are you buying? You're buying the S&P 500, weighted exactly the same as the S&P 500, and that's traditional indexing. That's where the first, trillion to 2 trillion came in, and then, it was really kind of after the dot-com crash in the early 2000s that people started to ask the question: is there another way to do indexing beyond market cap indexing that can make sense? Is there a way where we can maybe have some downside protection? Is there a way where we can dampen volatility? Is there a way to come up with an index that could maybe beat market cap indexing over the long haul? So either return enhancement or risk management, or just anything different. So anything that is index-based or rules-based that is not based on traditional market cap indexing is strategic beta. And strategic beta ETFs have been growing faster, both in offerings and assets, than traditional indexing over the last 5 years. And we think this is also, along with fixed income, we would expect alternatively weighted rules-based investing to grow faster than traditional indexing over the next few trillion over the next few years. But you do have active management also. And active management ETFs have been around for a long time, and most of their success has been in fixed income, where firms like PIMCO will offer, they've got a PIMCO total return mutual fund, and then they offer a PIMCO total return ETF. And the strategies will diverge a little bit, but they'll basically try and do the same kind of active management in an ETF structure. Some of the impediments that have kept other active managers from entering active ETFs is the daily disclosure, right? When inherent in an ETF is perfect transparency. You can see the portfolio every single day. So from an active managed standpoint, the drawback is you can kind of show your hand. And if you've got a proprietary approach to the market and you're making a big move into a new asset class or a new credit or a new stock holding, the whole world can see it within 24 hours. And so that's been the rub that has kept out a lot of active managed strategies from entering ETFs. They want a way to cloak the portfolio so that they can have time to make a move without, fast money hedge funds or competitors seeing what they're doing and being able to copy them. So there are vehicles that have come to market, and there's new ones coming to market where they try and get around this, where they can kind of do the best of both worlds, where they can cloak the portfolio, yet still have this link to the market for liquidity and creating and redeeming the basket. So stay tuned. There's more to come, and there'll probably be more growth in actively managed ETFs. So,
Jay?
Yes.
Hey, I'm sorry to interrupt, but my understanding is that the SEC just come out and approved some sort of an undisclosed arrangement to serving that point that you just mentioned about the active managers not wanting to show their hands, that there's going to be the ability for them to come out with undisclosed active strategies.
That's correct. Yeah, and it's not the first time the SEC. There's been a version of cloaked active portfolios out in the market for a few years. And this is a new. There's actually 2 or 3 different versions that were approved by the SEC, and I think another 2 or 3 that are being looked at. So the takeaway I would give you all is stay tuned. It's in process. The SEC has approved them, but next step is they have to come to market. They need to gather assets. They need to deliver performance and liquidity. So we're kind of at the nexus of this really taking off.
All right, thank you.
No problem at all. And by the way, just as a quick aside on the SEC, the ETF rule was approved by the SEC, which is going to basically make the whole process of bringing a new ETF to market lower cost and easier than it has been for the last 20 years. Up until now, ETFs, they are 1940 Act mutual funds with a special exemption that allows them to be traded. And so what that created was a kind of a different set of rules depending on when you came and got your exemptive relief to bring your ETFs to the market. And so early entrants like Vanguard and BlackRock had different exemptive relief than newer people who entered the market in 2007, 8, 9, 10. And so the SEC, had been talking about this for the last decade, and they finally said, okay, let's just make a standard ETF rule that applies to all providers and have the same mechanisms in place. So that just got passed, and that's going to be implemented in 2020, 2021. So, so when you're looking at that, this is the question we get from advisors the most is, how do you differentiate among strategies and what are the key considerations when we go to choose an ETF and the things to think about. So I've alluded to some of this already along the way, but when you have a traditional indexed approach, you know how you're being weighted. You're being weighted by market capitalization. So the bigger your market cap, the higher weighting you have in the index. And this has advantages and disadvantages. One of the biggest advantages is perfect, clarity and understanding. People intuitively understand, what the Dow Jones Industrial Average is, what the S&P 500 is, what the Russell 1000 is. It tends to change slowly over time, so turnover in a portfolio is very low, and as a result, managing that portfolio can be done at a very low cost. And so, we're able to offer U.S. large cap, U.S. broad ETFs as low as 3 basis points. When you get into strategic beta, something else is happening, right? You've got something else going on, whether a tilt or a change in strategy. And so by definition, they tend to be more active and turn over more. So it's fine, you get something in terms of the way the portfolio is going to perform, but there'll be differences in costs in terms of managing it. And then when you get to active, hey, that can run the whole gamut. You have active managers that are, closet indexers that don't have really stable portfolios that don't change over time. And then you've got active managers who turn their portfolio over on a monthly basis. And so the weightings and the strategies change quite a bit. So when you go through portfolio construction, turnover, and tax efficiency, you'll see different things, right? So portfolio construction, you do have a market cap bias in traditional index in terms of, price momentum impact, right? If Facebook stock doubles in the next year and every other stock stays equal, and so thus it outperforms, it'll have a bigger and bigger part of its market cap weighting, and you'll own more and more of it in your portfolio. So you get this bias towards momentum and towards market cap, where strategic beta, could and most likely would avoid that kind of link to price. But in that, you get more turnover, you get more active rebalancing, and that can impact your tax efficiency. So one of the beauties of traditional indexed ETFs is that they can, by and large, avoid paying out capital gains over time. Wait for it, here comes another Schwab ETF commercial, I can't help myself. We haven't distributed a capital gain in any Schwab ETF since we entered the business in 2009. So the ETF vehicle allows you to take securities with gains in them and redeem them out in the in-kind redemption mechanism and avoid triggering capital gains. And so if you just take an index mutual fund and you put alongside a traditional indexed ETF, you'll find differences in capital gains treatments because the index mutual fund doesn't have that mechanism. And so if there's a turnover that triggers a capital gain, it'll bear out. And we saw that in small cap index mutual funds in 2018, where there was a big turnover in the Russell 2000. And so capital gains are delivered in index mutual funds. Same strategies in ETFs managed to avoid paying out taxable gains. That gets accentuated in strategic beta, and it gets really accentuated in active management, where the whole game in active management is to generate gains and deliver performance. And so in that turnover, every time the fund realizes a gain that's not offset by a loss, they pay out capital gains taxes. And so it's just part of the experience of owning an actively managed mutual fund, and in some cases actively managed ETFs, where they can't, the gains overwhelm their ability to do it in a custom redemption basket. And so they're not as tax efficient. And again, cost structure, I mentioned in traditional indexing, the world now lives in a single basis point digit world, right? So broad market equities are at 3 basis points. Aggregate fixed income is at 4 basis points. Treasury ETFs are 5 or 6 basis points in terms of your operating expense ratios. So really the lowest cost exposure that you can get in the fund market is at ETFs. Strategic beta is right behind it. I mean, there is a strategic beta ETF out there at 9 basis points. The average in the space is closer to 30 basis points. So still low cost. When you move into actively managed funds, your average goes north of 50 basis points. And in fact, it's closer to 65 basis points. So cost structure, lowest in traditional index, next lowest in strategic beta, and then not so low over in active management. Again, of course, your return characterization is very different. When you go to traditional index, what are you getting? You're just getting raw market beta exposure. You own the market. In strategic beta, you've got the potential to generate alpha, and you're seeking to potentially outperform the market, either in up markets or down markets. And then in active management, that really varies by what the fund strategy is. So again, index and strategic beta are index, and then of course active is active. And then when it comes to tracking error, with traditional indexing, given the little turnover, given the clarity in the index that you're going after, we can generally deliver almost no tracking error. And again, like the OERs, in traditional indexed ETFs, the tracking error, it lives in a single basis point digit world. Our tracking errors tend to look a lot like our OERs. So if it's a broad US market exposure and you're being charged 3 basis points, our tracking error versus the index is usually pretty close to 3-4 basis points. When you get into strategic beta, you get higher tracking error. Just again, the strategies are more complicated. There's more moving parts, and so you tend to either you're not tracking to the market in general, and you tend to have a little bit more tracking error even to the specific index of the strategic beta. And then of course active management, defining tracking error. The tracking error is usually a lot higher in active management because their benchmarks are not followed as closely, and in fact, they're seeking to beat them. So in a good outcome, they've got huge tracking error to the upside. The reality is for that industry, it's a little bit more mixed, but you're going to have more tracking error in active than you're going to have in index. And lastly, loss aversion. Of course, again, the whole reason that strategic beta and active management exist is to offer you some potential downside protection in market corrections. And in strategic beta, they may have that, right? It may be a strategy that has features that will look to counter moves to the downside, or they're owning deeper value securities that in theory should have more downside protection in a market correction. And then active, they may provide a level of downside protection as well. Traditional indexing, there is nothing. You own the market. So in terms of loss aversion, you're going to get that through a diversified portfolio among asset classes, not at the fund level. Okay, so let's go into core ETF features. You'll expect to hear some of this you've already heard before. What are the key features of an ETF? Well, it's like a mutual fund. In fact, it is a mutual fund. It's got diversified portfolios. It's got pooled exposures. But the key differentiator is that it trades like a stock. You can buy it and sell it anytime the exchange market is open. It's also considerably more transparent in that you can see the portfolio. Again, our website, you go into schwabfunds.com, click on the ticker, boom, you can download the portfolio to an Excel spreadsheet with a few clicks and a handful of seconds. So you know exactly what you own. And this is important to a lot of advisors because if they're trying to build a diversified portfolio, they want to be able to, see what's in it every day and avoid, owning the same assets across different strategies. In a actively managed strategy, the disclosure of a portfolio is generally done on a quarterly basis with a look back to the prior quarter end. So you'll know what you own, but you won't know it on a daily or weekly or monthly basis. You know it more on a quarterly basis. So I mentioned most ETFs, 87%, track an index. And so there are actively managed, but most are index tracking. Potential tax efficiency, they are tax efficient. Things that will trigger capital gains in ETFs, tend to be just massive turnovers that are generated by a alternative strategy or an international domicile that does not allow in-kind transfers. And so South Korea and China, for example, don't allow in-kind transfers. And so in the emerging market space, there may be times when you have heavy turnover among South Korea and China holdings that could trigger capital gains. But by and large, as an industry, when you hold an ETF alongside an index mutual fund, you're going to see a lot more tax efficiency in your capital gains experience. And again, generally lower fees than mutual funds. ETFs have been kind of the competitive trigger point for lower fund management fees. You are seeing the impact now on index mutual funds. Their pricing is coming down. And even in some cases, actively managed are starting to kind of move the direction towards lower cost, but it's been the ETFs that have been driving the market that direction, and they're already there. You can put together a completely diversified portfolio with all of your OERs sub 10 basis points. So again, general comparison, ETFs are like individual securities in that you can trade them throughout the day. And trading flexibility, you can also buy and implement put and call strategies for most major ETFs. So something to consider when you're looking at an ETF is it large enough? Is it liquid enough that it has an options tree? And so out of our 25 ETFs, 21 of them have fully developed put and call option trees built out on the exchange. So daily transparency, I've covered that. Of course, diversified portfolio, you get that in an ETF and a mutual fund, not in an individual security. Mutual funds do still have this advantage of automatic investing. And what that means is if you want to send $100 in to a mutual fund provider spread across 3 different funds every single month, you can put dollars to work. Where ETFs, you are at this date and time still bound by share prices. So, if an ETF is trading at $43 and you want to send in $60, you'd buy 1 share and the other $17 would be sitting waiting for enough money to accumulate to buy shares. And so this gives mutual funds a little leg up in some of the retirement spaces, 401k contributions where you're making a set dollar amount. All the money can be put to work on a daily basis in the mutual fund space where ETFs, the share costs. Now, fractional share ownership, which is a newer topic coming up, could level this and give ETFs that blue check mark in this space as well. Again, tax efficiency, which I've covered pretty extensively. ETFs have a leg up there over both individual securities and mutual funds. So, and most ETFs are designed to follow an index. And so when you're comparing ETF to ETF, it is worthwhile to look at what the selection process is for what goes into the ETF. And so, and our point is, you can be looking at an international developed equity ETF among different providers, and depending on who the index provider is and what the selection process is, you could end up with some fairly significant differences in the portfolio composition. So we always say, take the time to look at the selection process. What do they define as their selection criteria? How often is the fund reconstituted and rebalanced? What's the weighting methodology? Obviously weighting methodologies can vary from market cap weighted to equal weighted to all sorts of different weighting methodologies. And how does the index calculation done? So these kind of 4 criteria are the different variables that can result in different exposures in a portfolio. So this is something I spend my time doing. An advisor might come down to choosing between 2 ETFs, not even necessarily Schwab ETFs. They'll send them to us and ask them if we can articulate what the differences are in these variables that might result in different portfolios and risks in the portfolio. So I want to talk a little bit more about tax efficiency. And I already referred to the 2018 small cap experience. So let's use that example again. Because just not everyone understands that that ETFs are tax efficient, but I want to just shed a little light as to how it is that happens. So in June of 2018, Russell 2000 had a higher turnover year than normal, so they went to reconstitute their index. And I'll use round numbers and say, upwards of 20% of all the constituents in the Russell 2000 had graduated out of small cap status. Now that's a good thing. That means these small cap companies that were $4, $5, $6 billion market caps had grown through price appreciation to be north of 12 billion, and they were no longer small caps by definition. So Russell, puts the whole universe out. They find a bunch of other smaller companies that had grown from not even being eligible for small cap into small cap, and they grabbed all the companies that were too big, and they published to the whole world, hey, we're making these changes. Here are the companies that are leaving. So if you're a small cap index mutual fund, on June 30th, you had one choice and one choice only, and that is you sold all those companies. They're no longer in your index, so you need to get rid of them, so you sell them. And by definition, since they were companies that had grown, your cost basis on them was lower than where the sales were made. So huge capital gains were realized at the fund level. And they sit in the fund until the end of the calendar year, and then they're accounted for and paid out, and 1099s are distributed to all the holders with taxable gains. Go to the ETF example. ETF following the same exact index, they see the same experience. Here are all the companies that are leaving the index. What they're able to do is they're able to reach out to authorized participants, and the way it actually works, our authorized participants are banging on their door saying, hey, we've got shares of your ETF. We'll deliver you shares of your ETF worth $100 million, and in exchange, we'll take from you a basket of securities out of the fund worth exactly $100 million, so it's an equal trade, and the basket of securities will be all of the securities that are leaving the small cap index. And so that in-kind exchange is done at the end of the day, and it is recognized by the IRS as a non-taxable event. So the economic gain is realized and stays inside the ETF and is not borne by the shareholders. And so what that means as an investor is if you own that ETF, all the capital gain is reflected in the share price of the ETF, and you'll pay that capital gain when you sell the ETF, but not before. So that's a quick synopsis of how ETFs and the mechanism for the in-kind exchange, how they're able to transfer out embedded gains in a fund without triggering capital gains. This has been going on since 1992. It is not a part of any agenda for tax code change. In fact, the SEC, when they came out to put the SEC rule, the ETF rule this year, they said ETFs have been a very effective means for investors to get long-term exposure to the markets. And so we're creating this rule and acknowledging that is it's a more efficient vehicle for investors. So, because people ask about this all the time, like, well, is this ever going to go away? Not on our radar screen, not a part of any discussion about taxes materially in the last 2 decades. So we expect this advantage to stay for the long haul, and it is one of the big and taxable accounts advantages for ETFs. Did that trigger any questions from anybody? Usually that does. And if it doesn't, that's okay. Okay, well, then let's move on. I covered transparency, right? ETFs are published their holdings daily. Mutual funds publish holdings either monthly or quarterly. A vast majority of ETFs are in rules-based strategies. So not only do you know what's in it every day, but you've got a pretty good insight about what's going to be in it tomorrow. And you have a feel for, again, back to that small cap example, you know that every June, Russell, if it's a Russell 2000 based ETF, you know that that's going to happen every June. If you wanted to, you could even look at the portfolio and pull it up by market cap, and you could have some pretty good insights as to which of the companies are probably going to be transferred out. So you've got transparency in what's in the portfolio, and you've got expectations and predictability about what will be in the portfolio in the future as well. So that's how and why ETFs are considered more transparent than mutual funds. So let's spend a little bit more time on choosing the right ETF and some of the factors that you might want to consider. The first thing to consider, generally people will come to me and say, oh, you're going to say price. It's all about price, right? Just go to the cheapest one. And a lot of people do this. A lot of advisors and investors just choose ETFs based on price. And you might think that we would say that's the right thing since we occupy the lowest price point in most spaces we compete. But we actually say it's exposure. So the first thing that you want to focus on is what is the fund bringing to you, and what are the investors' needs at the portfolio level. So just make sure you're getting the right exposure. Do they need, do you have an investor that owns, all U.S. equities and is looking for international? Well, so then of course you're going to be looking for an international exposure. If they've got a diversified portfolio, just look for missing pieces and exposures that make the most sense for the portfolio. That's where you start, of course. And then after that, then look at total cost. And notice we say total cost, not just the operating expense ratio, but how liquid is the fund? What's its bid-ask spread? Trading commissions used to be a bigger part of this conversation. Of course, that's not a part of the conversation now in most places. So, but that's the total cost is expense ratio, tracking error differences, how efficiently do they actually deliver the returns of the index they're following, how liquid is it in terms of bid-ask spread. So total cost, that's number 2. And then number 3 is the portfolio relevance. And what we mean by this is, beyond asset class exposure, is this a strategy that will complement what you already have? And this is a big part of the case for strategic beta. Maybe you've got someone that has a pure market cap based portfolio, and they've got new money and they're looking for more diversification. Well, you can diversify beyond asset class into return profiles by moving into strategic beta. And there are strategic beta strategies out there that are meant to complement market cap. And what we mean by complement is behave differently. And so if you implement them together in a portfolio construction and you do rebalancing over time, you take advantage of one that's outperforming over a certain period of time and buy more of the one that's underperforming, and you can end up at a better place on the risk return spectrum. So those are the kind of the big 3 in terms of how we think you should approach choosing the right ETF. Start with exposure, then look at total cost, and then look at the relevance of the portfolio, the impact of the fund on your overall portfolio construction. So across different ETFs, you can have different exposures. I'll just use this example in the international developed space. So I think the largest developed ETF in the market is by iShares, the iShares ETH ETF. We've got the Schwab International Equity ETF. So they follow MSCI, and we follow FTSE Developed. And so MSCI has South Korea categorized as an emerging economy. And most of the major index providers have been looking at South Korea, trying to decide when they're going to bring them over to the developed space, because they're the 13th largest economy in the world. They've got a big share of the automotive industry. They've got a big share of the global technology industry. Their literacy rates exceed that of the US. So by almost any macroeconomic measure, they are a developed economy. But for now, MSCI still has them as emerging market. So if you buy our developed economy, you get South Korea. If you buy this one, you don't. And they also, MSCI doesn't include Canada as a developed country. They kind of lump them in with the U.S. As a North American entity. So big differences can result in the portfolios. We have Canada in because in FTSE has Canada in because they recognize them as their own sovereign country with different return attributions than the U.S. They actually tend to be pretty concentrated in natural resources and have different return profiles than the U.S. So we think it makes sense in an ex-U.S. strategy. And so just taking a look under the hood to see how indices are comprised, you'll see differences like this that can add up and have different return attributions. So worthwhile to look underneath. So shareholder cost considerations between ETFs and mutual funds. Again, the obvious things are operating expenses, where ETFs tend to have a big edge over mutual funds, just in sheer number. And also, it's fairly simple. What are your expenses when you own an ETF? Well, it's the operating expense. If you're an owner, beyond the transaction, that's the only fee you pay. Mutual funds can have other fees associated with them. You do need to look at bid-ask spreads when you're looking at ETFs. Again, you don't have to think about that with a mutual fund, because it's as simple as sending them the money, and at the end of the trading day, they send you, your fractional shares. They're not traded. Well, so in ETFs, you do have another consideration. How big is and actively traded is the ETF? The perfect bid-ask spread scenario is 1 penny among best bid and best offer, but that can vary and run up to 20, 30 cents, which becomes a significant proportion of your cost if you're buying and trading often. So look for liquid ETFs with very narrow bid-ask spreads. Commissions. Again, commissions are going away for a lot of the industry in terms of ETFs. Mutual funds, may or may not have them. It may come in the form of a sale load, so it really depends on the asset manager and the platform. Distribution expenses, they don't exist in ETFs. They're covered in the management fee. They can exist in mutual funds. Purchase and redemption fees are born in an ETF. When I talked about that in-kind exchange, there usually is a nominal fee, and I say nominal because those are institutional trades, usually comprising 10 to 50 million. And so a nominal fee of $2,000 or $3,000 is pretty small on a percentage basis, but it's borne by the AP. With mutual funds, you may have that as you buy and sell. You could have purchase and redemption fees. So those are some of the differences. When we look at tracking difference, I mentioned the best case scenario is you're tracking the index down to a single basis point. The biggest contributor to how a fund performs versus index is its expense ratio. So, that makes sense, right? If you're buying a bond ETF and it's got a 50 basis point, 0.5% OER, and it's trying to replicate an index, the portfolio management team has to find a way to generate 50 basis points of outperformance just to match the index. And so, by contrast, if you've got an ETF that's charging you 5 basis points, they're obviously going to have a much lower hurdle to delivering the underlying index. So the expense ratio is the biggest input. How often and how expensive transaction and rebalancing costs are next. And that depends sometimes by the frequency of the rebalancing and also the asset class in play. There's a feature called cash drag that can happen with ETFs. And this really refers to ETFs like SPY, which again came to market in 1992. In their mechanism, they're actually unit investment trusts, which was the first kind of variation of an ETF. They're not allowed to reinvest dividends. So as the S&P 500 pays out dividends over a quarterly basis, what SPY does is it just takes the dividends and it sits on them and holds them as cash. In further iterations of ETFs, they have the ability to reinvest those dividends in the underlying index. And so in the meantime, you get paid out whether you get paid your dividend on a monthly basis or a quarterly basis, it's reinvested in the fund, and you've got potential appreciation in the interim time period. So cash drag, that explains why some of the S&P 500 ETFs have outperformed SPY over time, because they have the ability to reinvest the dividends. So how often it's rebalanced, portfolio optimization versus sampling versus full replication or versus replication. If you think about this, there are ETFs out there that are following an index with as few as 30 securities. So if one of our treasury ETFs would be an example. SCHP, which is our Treasury Inflation Protected Security ETF, its index has around 30 treasury securities in there. So of course we own all 30, right? And we would call that replication because we actually own all the securities. The S&P 500 is another example. You can generally own all 500 of those companies in a portfolio. When you move into like a broad equity, a U.S. broad strategy where there could be as many as 2,800 securities, you may find that you're better off from a portfolio standpoint in doing sampling. So maybe those last 100 companies, the transaction cost to get the 1 basis point of exposure might exceed the potential return. And so they'll look to replicate them by owning, a slight overweight in the sector. So that's a quick explanation of sampling versus replication. And then lastly, securities lending. So we don't go into what securities lending is explicitly in this presentation, but I will highlight that in 2 weeks, on December 17th, one of my teammates is going to deliver for you the advanced ETF concepts, where we spend a good portion of the presentation delving into what securities lending is and what some of the differences are in practices among providers. But at this point, just know that securities lending revenue is additive to ETFs. And so it goes the most, in some cases, all of the proceeds of the returns go back into the fund. And so it helps close the gap between the fund performance and the index that it's looking to replicate. So to wrap up, let's go quickly through some facts or myths, which will encapsulate some of the concepts that I've covered. So the first one is fact or myth. All ETFs are market capitalization weighted. So if I could hear all of you, I would hear this big resounding No, that's a myth, because many ETFs are market cap weighted, but there is a whole host of hundreds of strategic beta and actively managed ETFs that are not based on market capitalization. So next up, ETFs are typically more tax efficient than mutual funds. And if I could hear you all, I would hear this big resounding, yes, that's a fact. ETFs are typically more tax efficient than mutual funds. Because of their unique creation redemption mechanism, they can avoid paying out intermittent capital gains. Next, ETFs are taking over the asset management industry, and index mutual funds are shrinking. Now, this was early in the presentation, but I would still hope that some of you would remember that that is a myth, not true. Index mutual funds, in fact, are still growing, just not as quickly as ETFs are growing. So ETFs have experienced robust growth, but so have index mutual funds over the last 1 year, 3 year, and 5 year time periods. And I think this might be lastly, when selecting an ETF, the operating expense ratio should be the primary selection criteria. If I listen to you all, hopefully you would all say, no, that's a myth. You really should look at several factors, including what's the exposure, what's the total cost, and what's the relevance to the portfolio. So thank you very much all for listening in. Hopefully you got a lot out of this. We tried to cover the ETF landscape, the key features of ETFs, some of the criteria in choosing the right ETF. And this is a part of an education program that we have here at Schwab called ETF Know-How. And you know, we've got do webcasts like this, we do in-persons, we publish quarterly strategy commentary on the ETF market. But I'm sure that your team can direct you to more of these resources that we offer. So I'll stop there, and we do have a few minutes to take any questions if that presentation triggered any.
DJ, it's Mindy. I'll just pop in real quick and thank you and thank everyone for participating. I don't know, again, I don't know if you guys are all muted or not. I think we're not sure of the technology here, but does anybody have any questions? I don't see any raised hands. Okay, well, I will, again, I just want to thank DJ for your time today and for presenting to us. And I will follow up with you guys. And certainly, my name is Mindy Folger. I think I've met most of you, but we'll reach out to you and see if you have any additional questions. And I welcome you to reach out to me as well. Happy to be helpful. If you don't have my contact information, Tracy certainly does. So thank you, everyone, for your time.
Thank you both very much.
Thank you, Tracy. We'll talk to you in 2 weeks.
Thanks, Tracy.
All right, great. Thank you.
Thanks, DJ.
Bye-bye, everyone.
Bye.